Welcome to today's Heavy Hitters Report. I'm going to go ahead and start here in a couple of seconds. Get things situated. See if we can get everything set up. A lot of good stocks that are continuing to break out. We're going to go through them. Obviously, today's report is going to be focused more on, or exclusively on, I should say, U.S. domestic stocks. We're looking at the biggest stocks that are listed. They're domiciled inside of the United States. You're looking at them right here. This is the top 30 of the largest US-based stocks filtered through by their proximity to 52-week highs. And so what we're trying to do here is really highlight the strongest stocks in the market. Most of these trading vehicles are going to have volume on the options chain for those of you that are worried about trading things strictly through options. A lot of really good stocks here. And for the guys inside of TTI, we're already in a bunch of these names, which should instill a whole lot of confidence with what we do here every single week by going through these heavy hitters. And of course, we're going to consistently look for more and more. So what we're looking at here right off the bat, and something that we had talked about earlier inside of the Discord, is that there is sector rotation going on under the surface, right? We've talked about it extensively. A majority of these stocks right now that are being highlighted and are breaking out into new 52-week highs and all-time highs, as you'll notice by looking briefly at the industry groups listed here, there's not a lot of technology, consumer discretionary, or communications-based names. A majority of the flow right now, with the market breaking out into all-time highs, are going into some of the less owned areas of the market, things like consumer staples. You see Coca-Cola there. 52-week high, all-time high breakout. And we have a position in Coca-Cola right now because of that. That's a consumer staples related name. Progressive, an insurance related name. So financial sector. Philip Morris, another consumer staples. Tobacco. Colgate, palm olive. Consumer staple. Altria Group, tobacco. Car, breaking out into an all-time high today. And if we actually go and look at CARR, this is a trade that we put on back in April that is now currently sitting at around 100%. So we're going to go through this heavy hitters report, but what I want you to focus on here is that, yes, obviously the sexy trades that everybody wants to take, and we have exposure in, but the Apples, the Microsofts, the Nvidias, the Teslas, the names that move, the names that normal people like to trade because they don't think outside of the box, we do. We think outside of the box. We are more inclined to own strength in less well-known names because they're performing well than buying the overcrowded trades simply because everybody needs to trade Apple, right? No, that's not true. We trade Apple when it's the trade to take. We trade Car, which is a consumer staples / industrial related name, industrial machinery industry group breaking out into all-time highs. We love the setup with price up and over the 200-day moving average, sloping upwards into big blue skies, RSI in a fully bullish momentum regime, right? We're going to take the trades that the market gives us. We're not going to fit our view of the market into a specific trade. And that's why we've been a group for over 4 years. And we have members that have been here since day one. We consistently find a way to pull profit out of the market. So if we go back and actually look at that heavy hitters report, once again, keep an open mind to some of these trades. These are the best companies in the United States, regardless of whether or not you want to trade them. Keep in mind that these are the names that typically move the S&P 500. So as we go down this list, Berkshire Hathaway, is that a name that we're going to want to trade? Probably not, but we know there's a significant amount of financial exposure and up until recently, a significant amount of Apple exposure, all-time high. Uncle Warren Buffett there, all-time highs, Berkshire Hathaway. T-Mobile. This is a leading communications-related name, breaking out into all-time highs. Beautiful base breakout at 154. At this point, there's no real opportunity to own any more of it. But if you were looking at owning any of the telecom providers, AT&T, T-Mobile, Verizon, the choice was very, very simple at the beginning of 2024. Now, admittedly, I do not own T-Mobile, and I'm okay with that. We own many other names inside of the communication sector. We've owned Meta and still do. We've owned Google. We own Netflix. So we are absolutely long the comm sector as it breaks out into all-time highs. But T-Mobile is a great example of industry groups do not have to move the same. Verizon has been pinned underneath overhead supply since 42.5. Stage 1 accumulation base going back to 2022. Why would you want to own Verizon as it's pinned under overhead supply? Why would you want to own AT&T as we're still trading below pre-COVID highs when you could have owned or traded T-Mobile? The power of owning stocks that are going up, dividend or not, which is a huge, to be quite honest, bullshit answer. I own this stock because of dividends, I understand, but as a retail trader, you're not Warren Buffett with billions of dollars locked up. Own dividend-paying stocks that are also appreciating. Get paid two ways, not just one. So T-Mobile, a good name on the heavy hitters report. Unfortunately, no opportunity there to add in there. MMM, 3M here, was an opportunity and will be an opportunity shortly. This is a power earnings gap into a COD setup. You see the chicken scratch on the chart. We've already talked about this. A couple of aggressive traders took this last week. They're getting paid today. We're going to look for a potential pullback on Triple M here, and we're going to get long with some time. We're not buying October's or September's on a stock that moves 2.78 ADR per day. This is a stage 1 into a stage 2. Cut the range in the mid. Put a price target on there based off your fib extensions. You had a 110 breakout, which unfortunately got gap through, which is why we waited to own it. We wanted to own it above 130. Next price target up 175. That is pushing up in towards multi-year highs. This is a name that we want to own. Paul Tudor Jones, one of the greatest investors and traders that is currently living, has a very simple risk-on, risk-off rule. He says stocks trading above a 200-day moving average are a green light. Stocks trading below a 200-day moving average are a red light. You either short them or you stay away from them. Triple M was trading below the 200-day moving average for the most part over the last few years and just recently flipped up this year. Now we're getting up and over overhead supply. We have the upward sloping 200-day moving average to back it up, showing us that this trend has had enough time to influence a slow-moving moving average. From a swing trading perspective, which we all are in here, we don't take little dinky-dunky day trades. We have serious cash on the line. We're looking for bigger moves. Good opportunity to own a U.S. domestic, large cap stock moving into a stage 2. It's a $72 billion company, and we can own this. Once again, it's a power earnings gap into a COD setup. If you're inside a TTI, you know what a COD setup is. We will be looking at owning this as early as later today. And for those of us that are already in it, congratulations. Nice continuation play on 3M. We've looked at names like ADP as recently as early last week. Not necessarily something we want to own here. We highlighted this kind of area of contention. ADP is breaking out now into all-time highs. Argue however you want about the economy. Argue however you want about how stocks have to fall, but they're not. Stocks are not falling. A recession is not currently looking like it's being priced in, or if it is, the market just doesn't seem to give a shit. You can short this if you want. But I don't see why ADP breaking out into all-time highs right now is necessarily a bad thing. The best part about trading these all-time highs is that it's very simple to know where you're right or wrong. I'm not saying that they all work out, although trends tend to trend longer than most people expect. You have a distinct advantage buying all-time highs because there are no previous buyers up here looking to sell into strength. You're in big blue skies. But the simplicity of a trading setup in all-time highs is fantastic because you draw the horizontal level, the zone, up into those all-time highs. You're north of it, you're probably long, and you're winning. You're south of it, you probably bought a fake out, and it's either time to cut or time to wait to enter. Once again, it's not necessarily that all of these are going to work. but they're very, very simple to understand and set up. It's pretty hard to screw up an all-time high trade. So ADP breaking out into all-time highs there. The options chain is a little less than desirable, but still there could be a play here at 1.68 ADR. Not really the type of trade you want to lock up shares into because it's just going to take forever. RTX is a trade that we've put on. For those of you that have been with us for at least 6 months, we've been actively looking to get long RTX, which is Raytheon, for the last few months. And it's up into all-time highs. Now, we were just talking about this yesterday. Industrials are breaking out into all-time highs, but so are aerospace and defense names. You can't trade all of these. Not all of them have the liquidity, preferences that we like, particularly those of you that are trading options. But aerospace and defense broke out as early as Q4 of 2023, and basically this year has been straight up, riding an upward sloping 200-day moving average. So RTX, one of the more liquid names that we could trade. Power earnings gap a couple of weeks ago and continues to press into all-time highs. So if you're in RTX, there's nothing to do here except manage risk. Congrats. A great trade. Don't time the top. Another good example that has been on our heavy hitters report for an extended period of time, by the way. It feels like every week the stock's up there. Let's talk about one of the better trades that we took this year, JP Morgan, pressing back up into all-time highs. Now, JP Morgan was a trade that we took early on in 2024, late December 2023. Now, when we put this trade on, as always, the chirpers, Twitter, TikTok, wherever, the market has to roll over. There's no fucking way JP Morgan can go to all-time highs. And yet here we are all year, and JP Morgan is up 28%. This is a mega cap bank stock. This is the most important banking stock, not only in the United States, but in the world, JP Morgan. Upward sloping 200-day moving average. We grabbed this off the 170.50 pivot. We still have a shares position. The options position, though, we sold for 500, 600%. Correct me if I'm wrong, TTI guys. We have been unable to find a new foothold. But now as we break back out into all-time highs, we're in the second half of the year here. We're on the right side of the earnings report. It's time to start looking for a new JP Morgan position. Remember, we don't just buy things because they're breaking out. We buy things because they have sector and industry strength on the back end. We are not a bottom-up style trading group. We are a top-down. We believe the bigger picture is more important than the individual stock. So we go and find the individual stock to fit the bigger picture. Why do I bring that up? JP Morgan is pressing into all-time highs, but so are all of the financial sectors. XLF being the biggest one that we track, all-time high today. Regardless of what anybody says, they've been wrong all year that the financial sector was going to roll over. It hasn't. Being long financials has been the right play all year. It continues to be the right play as we continue to break out into all-time highs. Regional bank industry group within the financial sector breaking back out, or at least attempting to set yearly highs. We've almost entirely made back last year's Q1 sell-off. That whole regional banking crisis bullshit that people were worried about doesn't even look like it exists anymore. And just to twist the knife a little bit harder, for those of you that are worried about a commercial real estate implosion, while I'm not in a position to tell you it can't happen, I will tell you that the poster child of commercial real estate, CBRE, is trading at all-time highs today. So if you are short CBRE, you are not having a good few weeks. A couple of weeks ago, power earnings gap shoved this thing up almost double digits in a single day. It continues to perform well. This is our big blue sky setup on a large cap name. How do you screw this one up? Be long above previous all-time highs, get out, or be short below it if you want at your own dismay. JP Morgan is a name that we will own more of. BlackRock, we were just talking about this last week during the Heavy Hitters Report. We are waiting for the $900 pivot. $900 pivot, currently trading $884. Another large cap financial institution that apparently owns 80% of American households. I don't give a shit. I'm here to make money off the stock. I'm not here to argue about whether or not BlackRock is a morally corrupt company. I don't care. This is an uptrend that we can buy the breakout of at $900. It's a financial related name. 200 moving average is sloped up. We're within a bullish momentum regime that just started a couple of weeks ago. With a 1.78 ADR, this is a better options trade than it is a shares trade. I'm going to say that again. With a 1.78 ADR and into all-time highs, this is a better options trade than it is a shares trade. We will find an opportunity to get long through calls. No call debit spreads. We do not want to cap potential profit in a low IV environment. We don't want to do it. We want to be long straight calls above $900. That's the plan. We're not there yet. When we get closer, we'll actually find the play. We're not long Walmart, but Walmart, big gap and go a couple of days ago, gave the green light to a majority of the largest retailers in the United States. It's not just Walmart. The consumer is dead is what we're told. Walmart said, no, they're not. If you read anything about the earnings report, which I unfortunately had the dismay of doing on accident, the earnings report said that they are seeing zero problems with the consumer. Nothing. That's back-to-back gap and goes in Walmart. Is the consumer as bad as what the media is telling us? Maybe, but the stock sure isn't trading like it. Ross, all-time highs off of the Walmart ER. Once again, is the consumer as bad as what the media is telling us? I don't know, but the stocks aren't trading like it. TJ Maxx, all-time highs. Once again, is the consumer as bad as what the media is telling us? I don't know. Dick's Sporting Good, all-time highs. See where I'm going with this? Move away from what the media is telling you. Focus on strength in the market. Your job as a market technician is not to interpret the economy. Your job is not to chase headlines. If you're a technician, meaning you follow price, meaning you follow trend, you do not give in to the same crap that the rest of the 98%ers do. There's that stat that goes around. Active traders, discretionary traders, 98% of them are never going to have anything long-term in terms of returns. They never will. You got the guy forwarding you headlines via a group chat that the world's about to implode because the Japanese yen carry trade imploded and everything else. Fuck them. Let them. It's not your decision. We follow trends in price. Dick's, Ross, TJ Maxx, Walmart, and just to twist the knife one more time, Ferrari's at all-time highs. Walmart, we do not have a position right now, but we will probably have a position in Target, which is not on this list right now. So I'm not going to cover it. The last one on this list that I want to talk through that we did grab a position in and is working right now is PayPal. I'm going to turn this into a log chart to make it a little bit easier to see. Full transparency, this is the third crack at PayPal that we've taken. The first one was a miss. The second one was half and half. I lost on it, but some of you guys had better entries, so you made a couple bucks. The third one looks like it's sticking the stage one into a stage two. So congratulations to those of you that grabbed this. It's working. We talked about the trade idea on the market research portal about what made this particular entry a little bit more desirable than the previous two. But for the first time, with the volume, with the bullish momentum regime, we have an upward sloping 200-day moving average. Now that might seem like a very minor detail, but notice how many times I've mentioned it today alone. And notice it. How many times I mention it when we write up the trade ideas themselves. I always refer to whether or not the 200-day moving average is sloping upwards if we're going long. These long-term moving averages take a lot of data to influence slope. I'm taking you back. This could be a nice little... When did we learn slope? Middle school? When was the last time you heard about slope or thought about slope? The slope of a moving average matters. If it's going straight up, parabolic, is it reasonable to expect the trade is probably not going to continue at that rate forever? Yeah, probably not. Parabolic moves typically end terribly. But if you're in early, you can make a lot of money. The longer term moving averages take a long time to move for that slope to change. As a matter of fact, using a 200-day moving average on a daily time frame means you need 200 candlesticks to start moving and influencing the slope of that trend line, or that moving average, excuse me. So a 200-day moving average is going to average out the last 200 days. If we start to slope up, that means that maybe over the course of about the last 40% of the year, there's something there. 50% of the year, there's something there, right? So we're breaking out upward sloping 200-day moving average. We have RSI well above 50. And by the way, it's an overbought territory at the highest rate it's been since the bull market back in 2020, 2021. So there's a lot to like about the PayPal trade. We're already in it. It's not free, I don't believe, for anybody, but make sure we're looking at flipping that half off, 100%, make it free. We have lots of time. And by the way, we got very lucky with the contracts that we bought because we are within stone's throw already of in the money, and we have time on these. So by the time everybody starts recognizing the fact that PayPal is actually starting to do a little something, we're going to have a free trade on the books, which you know is the best thing that we could do. How many lotto tickets do we have that are completely free on things like NVIDIA, for example, through earnings that we were able to sell half at 100%. And now as we go through earnings coming up this week, we don't have to worry about it. If NVIDIA dies, those lotto tickets die and we lose nothing. If NVIDIA moons, we make a shit ton of money. We're constantly assessing and managing risk first and then looking at reward second because we're winners. Right? Okay. So that's what I got for you. Go ahead and look at the heavy hitters report one more time. Feel free to read through the newsletter when it comes out in about 20 minutes. We're in a bunch of these names already and they're working for us. There's not a whole lot to do here except to let the market continue to work for us. We've talked about this plenty of times this year. The people preparing for the end of the world are the people that are screaming the loudest right now because they have been wrong. All year they've been wrong. Let them continue to be wrong. Stay long strength. We'll manage risk as it shows up. Coca-Cola #1 on the list right now, and we have a position. Once again, very simple setup at all-time high. Buy the 67 area breakout and wait for the 100% move to sell half of the contracts. Let the other half continue to run to the price target. This is how this stuff works. This is why we can take people that have full-time jobs and commitments that can't dedicate themselves all day staring at charts. This is how they win. Buy 6 months of expiration, buy the right type of setup, and go do shit with your life. All right, that's what I got for you. Thank you for joining me. This is August 26th Heavy Hitters Report. My name is Hamilton. I'm here at the Trading Initiative. If you have any questions regarding anything that we talked through, any concepts, any trades in general, feel free to leave them below on the market research portal side, and I will answer them. For those of you over on TikTok, I haven't read a single thing you've said, but if you like this stuff, feel free to leave a comment as well, and I'll answer it if it makes sense, all right? Enjoy the rest of your Monday, and if you're inside of Discord, I'll talk to you in a couple